Hello and welcome to this week's edition of Reverse Mortgage Weekly. It's a weekly that I'm doing to talk to people about reverse mortgages. Again, eventually I want this to be an interactive event where people will be on the live Zoom call, we'll be doing interviews and things of that nature. But today we don't have anything lined up except for me, the talking head, talking at you here from Facebook Live. So welcome. It is May 19th, 2022. And today I just wanted to dive in. Last week we talked a little bit about some of the myths that people had about the program and some of the things that people think they know about reverse mortgage, but it doesn't really pan out when it comes down to the actual facts. And you would think that it would be pretty straightforward, but it's not. So there's a lot of misinformation out there. So I wanted to kind of address that. So let me go ahead and share my screen here, so that way you don't have to stare at me the whole time. We're supposed to get snow tomorrow, which I find a little crazy. It's mid-May. I thought we were done with getting snow this year, but I guess not. All right, so let me go ahead and share my screen here. So I wanted to just talk a little bit about, why are people looking into getting these? I mean, what is this? Is this something that is going to be of benefit to people? I talk to people a lot about these programs, and often, referral partners or people that I talk to are talking to me about someone that they know in particular that is, in a tough situation. I was speaking with someone this morning. Her parents are in their late 60s. They're still working, and like many Americans, they continue to borrow against their home. So they have a pretty large mortgage on their home, and he is aging, but as most men, we're some of us can be a little more stubborn than our own good, which comes in handy sometimes, because sometimes it's not so good. But he got injured on the job, and he's in his late 60s, and now he's in a situation where he may or may not be able to continue to work, and they have this big mortgage payment. His wife is at home right now. She's already retired, but they need that extra income to cover the mortgage payment. He has to continue to work so that he can cover that mortgage payment on a monthly basis. So in that instance, if you have a large mortgage on your house and you're put in a position where you'd like to retire, I mean, you think it would be a good idea to retire, but you can't. You're in a situation where you have to come up with that. You have to crack that nut every single month to come up with that monthly payment. And what the reverse mortgage will do is it won't eliminate your payment. I hear some companies in town talking about, oh, it's going to eliminate your payment. Technically, that is not true. And I don't want to come across that this isn't a loan or that you don't have to pay it back. That is absolutely incorrect. That is one of the misconceptions that unfortunately we do hear every so often. But what it does is it converts your mortgage into a payment optional situation. So if you want to make a payment on a reverse mortgage, you can. I mean, it's in my opinion, it's contrary to the strategy that we're trying to put together for an overall long-term financial planning type goal. And again, I'm not a financial planner. I'm not an attorney. I don't play one on TV. So just a little disclosure there. But in that situation, basically, if he's not able to work, he's not able to afford the payment. I mean, we have to take a hard look at some of his options. Number one, what a lot of people will say is, well, just sell your house. Sell your house. You still got a fair amount of equity in it. Sell your house and then rent. But in my opinion, that is some of the worst advice people can give. I mean, in some cases, that's all you can do. And if you don't own real estate, I mean, you're kind of stuck with that decision. You have to rent somewhere. And rents have just been going up and up and up here in Colorado. There's a huge shortage of affordable housing in Colorado. So renting is not going to be the best option for a lot of people. That's what the advice that a lot of people will give you is that, oh, go, sell the house, take a bundle of cash and then rent. But one option that they could look at is a reverse mortgage. Now, if they have enough equity in their home, we can basically convert that payment, that mortgage, into a payment optional reverse mortgage. Now, most people, 99.9% of people, generally choose not to make that payment, because what the philosophy is that instead of making that payment out of pocket each month, you basically will put yourself in a position where you can keep the money that you'd normally, say the payment's like $1,500 a month. Well, instead of paying that $1,500 to pay off mortgage interest on the mortgage, you basically keep that $1,500 in your pocket. You keep it in the bank. And that leads us to the question of equity, because most people are paying on their mortgage because they want to pay the note off. I mean, that, and they don't want to go late, so to pay off the mortgage in retirement, I think it's honorable. You can pay your mortgage off, all that stuff, but I don't know that it's the most wise thing to do for most people, because for instance, in this situation, if he has to quit working and then go on Social Security or something like that, then his cash flow is going to be pretty limited. So to be living by on scraps just so that you can pay down the mortgage, which, if you got a 30-year term, I mean, you're going to be paying on it all through your retirement years. It just doesn't make any sense to me. It doesn't make a bit of sense to me, because if you are paying a mortgage after 55, remember the minimum age for a reverse mortgage is 55 for most programs, or for some programs. If you're paying that mortgage, you're either paying it out of your life savings, which you want to hold on to for the rest of your life, because you don't know how long you're going to live. So your nest egg becomes vitally important, or you're paying it from a bucket where it's limited, being your cash flow. So to eliminate that payment or convert into a payment optional and take that $1,500, and just using this as an example, and basically put it in savings. I mean, put it in savings or use it for expenses, but you basically just give yourself a $1,500 raise each month by converting your payment into a payment optional reverse mortgage. That's what many of my clients have done. And in this situation, I mean, putting yourself in a position where you're aging, you're going to be working less, and now he's dealing with an injury. I mean, it's tough to say if he's going to be coming back at all. So at this time, I mean, those type of situations are going to be paramount, and really going to be in a good position to put themselves in regards to the reverse mortgage, because if you were to choose to do the reverse mortgage, they both decided to do a reverse mortgage. Not only are there going to be protections in regards to if one of them passes, then your income is cut in half. But if one of them passes, they'll be in a situation where they can still live in their house the rest of their life and not have to pay a mortgage payment. So there's a lot of protections in that sense, but just seeing that he could probably retire if he eliminated his mortgage payment, but he's working himself down to the bone so that he can pay his mortgage each month with, I just think is crazy, because there's other options out there. And really what it's all about is leveraging the real estate, leveraging the equity that you currently have in the real estate, because the equity itself is not doing you any good. So, can't take a picture of your house and go to the grocery store and pay for your groceries. And, you can't eat equity. So equity is great to have, but again, and I'd probably say this in every single reverse mortgage live that I've done, but I want to drive it home. I want people to think about this. Equity is great, but it's like having that glass coffee table right in the middle of your living room full of cash that you can't get to. So what the reverse mortgage does is it allows people to access that cash so that they can start converting that equity into cash. Now, in this particular situation that we're talking about, the gentleman who got injured, who has a large mortgage payment, we've used an estimate of $1,500. Basically, instead of paying that $1,500 each month, he's going to be taking that $1,500 and putting it into his bank account. So essentially, he's converting that equity or even interest a lot of times with forward mortgages, because you're paying mostly interest for most of the term. That's going to be converted into cash. And once you have cash, once you have that $1,500 in your pocket, you can do whatever you need to do with it. So that's really the philosophy behind the reverse mortgage. And when I hear stories about folks who are just, again, just working themselves to the bone just so that they can pay their monthly mortgage payment because they have a high monthly mortgage payment on a property that they'll probably never pay off in their lifetime. This is why I'm doing these videos. This is why I'm passionate about what I'm doing, because there are ways where people can have a better quality of life and not put themselves in a position where they have to work until they basically injure themselves or something like that. It's just, I just, my heart goes out to folks like that. And there are options that people can take so that they don't put themselves in that kind of position. So on the slide here, these are some of the main reasons why people are taking these out. Again, increased cash flow, optional payment or tenured payment. Optional payment, of course, that's the example that we just went over. Someone who is paying on a mortgage, working every single day, you know, doesn't want to work, but has to work, because if they don't, they're not going to be able to afford their mortgage. So eliminating that mortgage payment or converting it into a payment optional, automatically you give yourself a raise, because you're not going to have to come up with that money to pay that principal and interest payment. You're still going to be responsible for your taxes and insurance. Very important piece to that, because if you don't pay your taxes, you can get in trouble. And property taxes is what I'm referring to. You can get in trouble if you don't pay your property taxes. If you don't pay your insurance, you know, then you can be underinsured. They can force place insurance on your property, and usually that's much higher than what you could get on the open market. So taxes, insurance, HOA, if applicable, most places don't have an HOA, but if you do, you are responsible to pay those. So those type of things are the reason, you know, the increased cash flow is going to be a great option for a lot of people. And then a tenured option, if you see that there on the screen. Now, tenured is basically another way that people can access cash, can get into that coffee table full of cash with the reverse mortgage. And tenured is basically just saying that it's somewhat like turning your house into like an annuity or something like that, where it pays you back each month. So so we can set those tenured payments up at several different terms. Most people choose not to go to tenured payment because I think there's a conception out there that, oh, you know, I'm going to be getting like $2,000 or $3,000 back each month. Of course, we can set it up so that you do, but in most cases, people are not getting that much back. A lot of my clients will choose to do the line of credit so that they can kind of pick and choose when they want to withdraw cash from their equity. So that seems to be a good option for a lot of people. But, you know, some people like to have that supplemented income for, you know, 5, 10, 15, 20, 30 years, or for the lifetime of getting cash back from their mortgage each month. And that's what we mean when we say tenured payment. So secondly, asset protection. We'll go into a lot of the financial planning. Again, not a financial planner. I don't play one on TV. But the asset protection piece of the reverse mortgage is, in my opinion, the biggest overlooked thing that most people talk about, especially financial planners. You know, we talk about being a fiduciary, meaning that, you know, you have your client's best interests in mind, and many financial planners are fiduciaries. Well, if you look at people's assets, real estate is more than likely their largest asset. I mean, there's billions of dollars in real estate that's owned by people who are over 65 right now. And to ignore that in a financial planning, in some cases, it is just, in my opinion, unwise. And if you're a fiduciary and you don't talk about someone's largest asset, I mean, is that, are you really putting yourself in a position to look after your client's best interests? Because there's been a lot of studies that show that if you incorporate home equity into your financial planning tools, that your survivability rate of your assets is much, much higher in the long run, especially now. I mean, look at this bear market that we're entering into with the stock market. Cryptocurrencies, I don't think there could be a lot of seniors out there that are, invested in these cryptocurrencies. It seems like the millennials have really taken to that. And boy, has that fallen through the floor. I mean, it's really doesn't look great out there. I'm more in the Warren Buffett camp. He came out the other day. Someone asked him about cryptocurrencies, and he says, you know what, I'm not really, he doesn't really like them because they don't provide a service. There's nothing behind them. So I'm find myself in that camp. But in a bear market, I mean, one of the worst things you can do is take your money out. And I would venture to guess that many people are taking their money out right now because they don't want to lose their life savings, they don't want to lose their 401ks. But if you take your money out and don't ride it out long term, and some people don't have a long term left, but most of us do. If you take your money out early, you could put yourself in a position to really basically take a large loss. And we can talk about index funds and stuff like that. I don't want to get too much into it. And I'm not an expert, and I know a lot of people love index funds because you don't lose when the market goes down, and that's actually very safe investment in my opinion. But again, we're kind of diverting from the reverse mortgage, going more into financial planning stuff. And again, I'm not a financial planner, but that's how some people are looking at these programs. In my opinion, every single financial planner should be talking to their clients about a reverse mortgage if they are 55 or over, because they can put themselves in a position where they can create a safety net. For instance, if you're withdrawing from your IRAs after 70 and a half, I think they just changed the age limit on those. Again, I'm not a financial planner, so I don't know 100% for sure. But if you're withdrawing from your retirement accounts in a bear market, it's kind of like a double whammy. You're not only losing money, but then you're taking money as well. Well, some folks will choose to draw from their line of credit if they have a reverse mortgage. Now, if they're withdrawing from their line of credit, they can keep that money in the market. So on the upswing, because it'll go back up, it's like the seasons, there's an ebb and flow to everything, especially markets. It's pretty volatile as of late, but at some point it's going to go back up again. So if you can ride out the wave, you'll be in good shape. So you don't want to take out money in a bear market, because then, you're just, it's like a double whammy. So take it out of your line of credit. Live off of the line of credit during the slow times. And when it's good, when things are going good and your investments are flourishing, take out of those. So what you're going to do is you're going to put yourself in a position to have a much higher survivability rate of your assets if you choose to do that. Number 3, this is a non-recourse loan. So what does that mean? That means that you're never going to owe more on the house than what it's worth. Let's say we have another 2008 event where all the property values plummet, and we're a quarter of the property values that we have now. A lot of people who have forward mortgages are going to be upside down. A lot of people who have reverse mortgages are going to be upside down. But with the reverse mortgage, the difference is that if you sell your house, you're not going to be required to pay back that deficiency because it's a non-recourse loan. Whereas on a forward mortgage, if you're upside down, you got to go to the bank and say, look, I got to sell my house. Will you take less than what I owe you? And that's something that was very, very common in 2008. There was a whole market of short sales that sprung up during that time. Well, we're out of time. There's a few other things we can go into next week. There's no shortage of material here. There's just a ton of material that we can talk about. If you have any questions for me, you can always give me a call. You can reach me at 720-502 3278, or you can always go to chariotreverse.com. I'm happy to have a conversation with you. Doesn't cost you anything to bounce things off me, and I'm happy to do that. So I hope you have a wonderful rest of your day. I hope that I want to offer you peace, prosperity, wisdom, health, and all good things to you and yours. I hope you have a great rest of your day. Thanks a lot for your time.